This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So Warren Buffett was giving interviews again this week due to a big position that Berkshire Hathaway had taken in a company called Pilot Flying J. They are a travel center company. You probably have seen them driving around the country and also in Canada, actually. They have travel centers up there. They have about 750 locations with over 27,000 employees. So this is a big operation. They're the largest travel center company, and they had about $20 billion in revenue. They took a 38.6% equity stake, and over the next 6 years, they basically will build a majority position and own the company outright. So they, of course, had to announce it and go on. He went on television just to talk about it. And then he ends up talking about a lot of other things, including the stock market in general, whether or not it's overvalued, all that stuff. But I'm sure you were thinking when you heard about this deal that, what Buffett is buying travel centers? That's pretty boring, because I can guarantee you that if I had told you even in last week's Value Investor to buy Travel Centers of America, which is one of their competitors, and they are listed on the stock exchange, you could have bought Travel Centers of America anytime. You could still buy it right now. That you would have said, "Oh, Tracey, that's so boring. Why do I want to buy a travel center company?" But with Buffett and Berkshire buying it, it's reminded me of some of the lessons that Warren Buffett always imparts about investing, and that these are very important concepts to keep in mind for value investors and long-term investors in general about what to look for in a company and not to overlook certain opportunities, because there's things right before your eyes that you might not consider. So I'm going to go over a couple of the lessons I gathered just watching him on the interviews this week talking about this company. And then I'm going to give you 5 stocks that kind of fit in with this philosophy. Some are values and some aren't. But I'm not sure he got a complete value on this company when he bought it either, but I'll get to that a little bit later. So the first lesson is boring is beautiful. Like I was just talking about, no one really would have had travel centers on their watch list. And I know this because there's very few people following Travel Centers of America on StockTwits, and it's not like anyone's writing, hot to trot articles about how you have to go out there and buy the travel centers. But, there's always a lot of hype about the next great thing and how you should invest in it. And we're all talking about AI and social media and all of those super hot areas, which are hot and growing and interesting. But sometimes these so-called boring companies are the real superstars. So Pilot Flying J, for instance, isn't just a travel center, even though that's what they call themselves. They also operate restaurants in a lot of those centers. So they have over 279 restaurants, and that makes them the 10th largest restaurant franchise chain in America. And because they also operate the service stations at these centers with gasoline and all of that, they operate the 4th largest tanker fleet in the nation as well. So there's all these, plus they have the convenience stores in there. So they're selling a lot of goods. So they're basically a retailer on top of it too. So when you start to really dig down into what the business is, it becomes more than just, the travel center with the bathroom and maybe some showers for the truck drivers. It has its hands in a whole bunch of different areas, and it dominates this market, which, as we all know, is what Warren Buffett likes. So when you start to look at a company from this perspective, it definitely gets more interesting. And I'm sure many of you, after you heard the news of him buying this, were like, "Oh, of course, that makes total sense. That's a Buffett type company." But yet most of us wouldn't have seen it that way prior to his announcement. So don't rule out a company just because it's not based in Silicon Valley or because it seems boring. Keep an open mind when you're looking for investing opportunities. The second lesson I took from just watching him in interviews this week were to buy companies that are profitable. This might seem like a really basic requirement, right? But I was struck by something he said about the possible tax reform that they're working on in Washington, D.C. and its impacts on Berkshire Hathaway. He said Berkshire's many businesses were already making profits. They're already growing earnings under this current tax plan, as good companies will do. They will adjust to whatever regulatory and legal climate they're given and still grow the business under those requirements. So if the corporate rate is slashed down to 20% from its current level, to him, to Buffett and Berkshire, that's great. They will benefit if it gets slashed down, but they're already succeeding now. So long-term investors, remember to look for great companies that have already figured out a way to succeed, even by dominating competition and by adjusting to the regulatory environment to already be profitable and growing under those conditions. Because then if you do get something like tax reform that's quite dramatic, they're only going to do better under those conditions. So keep that in mind as well. And then a third lesson is to buy these building block type companies. So we all know that Buffett loves to buy companies that kind of operate in the shadows and that are these building blocks of the economy. So Pilot Flying J is one of those because you probably drove by one dozens, hundreds, maybe even thousands of times on your travels or even just going to and from work in some cases and never really gave it a second thought because it's always just kind of been there over the last couple decades. Similarly, we know Berkshire owns Burlington Northern Railroad. That's also a reason he bought a railroad because, again, we don't really give it a second thought. It's considered the old economy, but those railroads are still delivering all the products, many things that we're using today, including automobiles, still get delivered by the rails. So he likes to buy these businesses that operate day in and day out without much fanfare, but the economy wouldn't really run the same without them. And we take it for granted that they're there. So keep that in mind too when you're looking out there for companies to invest in, that these building block type companies aren't fly-by-nights. They're not flashes in the pan. They have a long history, and they tend to dominate their industries. Those are just 3 lessons I've learned from Buffett over the years and just from watching him again this week, because these are some of the themes he brought up in his interviews this week with this acquisition announcement. So I was thinking, what companies fit these lessons today, and are any of them value stocks? I couldn't really run a screen for this because there is no screen of, find Buffett type company screen. I wish there was, but there really isn't. So I just kind of had to tap into my own knowledge of what is a publicly traded company out there, what kind of fits into these 3 lessons. And then I looked to see, are they cheap? Are they not? A couple I did pass by because they were just a little too expensive for me right now, but a few of these are on the more expensive side as far as PE. But I do have to wonder what Buffett paid for the Pilot company because the terms weren't disclosed. He likes to get things cheap, but in this environment, in this hot economy, it's doubtful he got it dirt cheap. And they weren't desperate to sell either. So I would be interested to know, but we don't know. So keep that in mind too when you are considering buying into a business as an investor. You want to get it cheap, obviously, but sometimes the fundamentals support paying a little bit extra to get into that company. So let's jump right into the stocks. The first one is Parker Hannifin. The ticker is PH. They do motion and control type industrial as well as filtration. They do hydraulics. They have a $23 billion market cap. They've been in business 100 years. This is the building block type company. Their PE right now is 19.5. So it's kind of in general running right along with the market. The stock is up big in September, though. If you would have gotten it even just a month ago, you would have paid a little bit less. Earnings look good. It's supposed to be up 11.6% this fiscal year and another 12% next fiscal year. That's not awful for a 100-year-old business here. The price to book is 4.5, so a little bit higher there as well. But you do get a dividend paying 1.5%. So keep this one in mind. Our second company is Air Products and Chemical. This ticker is APD, and it provides atmospheric and process gases to customers in 50 countries. Yes, this is a gas company, but not like natural gas. These are industrial type gases. Shares have stalled pretty much, and earnings are on the decline. I didn't dig in to find out why earnings are expected to decline 17% this year, and then they're expected to rebound 10% next year. The PE is 22. They have a $30 billion market cap. Dividend is 2.5%, so you do get some dividend there for patience. And the price to book is 3.5. So not too awful on the price to book there. They were founded in 1940. So they've been around quite a long time as well. You kind of see tanks for Air Products when you're driving around the country, actually a lot, sometimes in, near manufacturing hubs and stuff. So that's another one to keep on your list. The third stock is Casey's General Stores. This is one of the favorites of mine, and they own a chain of convenience stores, mostly in small towns in the Midwest. I was just in southern Wisconsin for a weekend, and I saw several new Casey General Stores up there. They service mostly in markets and towns that are 5,000 people and under. They have the gas station, they have the convenience store, and they are the fifth largest pizza chain in the United States now because their pizza is really good. And in these small towns with only 5,000 people or less, you may have no other pizza place to go to. So not only is it good, but they are providing a service there where nobody else is. So I like that aspect of it a lot. They have a market cap of $4 billion. They're a little more expensive here, but these shares are also up recently. Their PE is 25. I keep waiting for it to get cheaper for me to buy it, but earnings expected to decline 4% in this fiscal year. That's why the shares actually sold off for a little while, but rebounding 12% next year. Dividend about 1%, so they do pay you something. And even though they got that PE of 25, they do have a price to sales ratio of just 0.6. So I like that with a price to book of 3.6, which isn't too high either. So even though they got that higher PE, some of their other fundamentals are value-ish there. So Casey's General Store, CASY. Another one that was a favorite until they kind of have stumbled recently is Hanes Brands. HBI is their ticker, and yes, they make underwear, t-shirts, sweatshirts, fleece, and some activewear. So they do the real basics of apparel, stuff that, you're going to need socks. You're going to need it. So they sell worldwide, and they have a lot of brands, in addition to Hanes. They have Champion, which does a lot of the sports apparel. They do Playtex, Bally, and Maidenform, which is on the women's side. That's like the bras and the underwear. So they were founded in 1901, and they actually own most of their manufacturing facilities worldwide, something like 90%. They have a market cap of $9 billion. This is one that actually does have value fundamentals right now. Their PE is 12. So I like that. That's lower than the overall market average, obviously, and under our 15 cutoff. Their price to sales is 1.4, and they have a much higher price to book of 8.1. But I like that PE. They do pay a dividend, 2.4%. You're getting growth, but it's not super dynamic growth. Earnings expected to be up 7% this year and 8.3% next year, but you're getting it pretty cheap at the PE of 12. So this is one where you have to judge and see if you can get in cheap enough to justify that slightly lower growth. But founded in 1901, I'd say it's not too shabby given how long they've been around. So Hanes Brands, kind of an interesting apparel play, and these have been beaten up. And then their fifth company is on the transport side, which Buffett really likes and most of us ignore, and it's Ryder Systems with a capital R is the ticker, and they do logistics and transportation, including having all those truck rentals. That's how most of us know Ryder. It's one of North America's largest fleets of trucks. They were founded in 1933 by Jim Ryder, actually, and they have a market cap of $4.5 billion, so they're not super big. Dividend is 2.2%. They have a PE of 19.2, which is kind of in line with the overall market. I wouldn't say it's cheap. I wouldn't say it's super expensive, but they have a price to book of just 2.1 and a price to sales ratio of 0.6. So those two fundamentals are definitely in the value category, and the shares have rebounded a little bit again with the overall market here. Earnings are expected to decline 18% this year. So I'd have to dig in to see why they suddenly have had this earnings decline, but they're expected to rebound next year, and they're growing sales about 5.5%. So overall, this is kind of hidden areas, the trucking side. A lot of people follow the railroads, including myself. But the trucking side is also should do well in a hot economy because obviously everybody's transporting things around the country when you have a hot economy. So this is another one to keep in mind. So let's go over the tickers again so that you have the list. Parker Hannifin, PH, Air Products and Chemical, APD, Casey's General Stores, CASY, Hanes Brands, HBI, and Ryder Systems, which is just R. And remember, you might want to have some patience and kind of see if some of these pull back after the nice rally that they've had, because then you can get them cheaper. They also have earnings coming up, so you might want to tune in to find out what's happening, especially on a couple of these companies where the earnings are expected to decline this year. Something is going on there. The conference calls are a good place to find out where everything stands. So definitely tune into some of those. Don't just read the transcripts. Anybody can, sign on while the conference call is going on. And most of the companies put them on their website afterwards so that you can listen to it after. And you get a lot of context when you listen to what the actual voices sound like and how the analysts are actually asking their questions instead of just reading the transcripts. So definitely tune into those. And I'll be having more podcasts about what's happening during earnings season with the value stocks as we get into this third quarter earnings season in the next couple of weeks. So be sure to tune in. And if you haven't subscribed it to the Value Investor Podcast, you can now do so in its own standalone program on iTunes. So go over to Apple Podcasts and subscribe to us there, or get both of the podcasts, both the Market Edge and the Value Investor Podcast, also on iTunes and on SoundCloud. So until next week, I'll see you then.